Welcome, everyone. Thank you for joining me again today for the Money Mindset Show. My name is Krista Wetmore, and I'm your host. So today I thought I would talk about holding companies. And as a continuation of the first episode I had last week, talking about the pros and cons of an incorporation. And holding companies are something that I think are misunderstood by many clients I've had over the years. Some that have them don't necessarily understand why they do. In other cases, I've met with entrepreneurs that should have holding companies and perhaps do not understand the benefit of having one. So let me just jump into what is a holding company. And a holding company is different than your operating company. So your operating company runs your day-to-day business. The holding company is just what the word says, hold. So typically it holds the shares of your operating company. Now, if it holds 100% of the shares, it's called a parent company. And it can also hold assets. So it holds cash, GICs, stocks, bonds, it can hold real estate, as well as land. So one of the benefits is holding company is a separate legal entity. So that's a benefit in itself, and I'll get into that in a minute. But there are costs associated with setting up another company. So as I mentioned on last week's show, on average costs of setting up a new incorporated company in New Brunswick will average about $1,000 to about $1,500 for a simple company. And don't forget that you also have the ongoing costs associated with that. So your annual filing of your income taxes, as well as the preparation of your financial statements. So that is something to consider because there are costs associated with that. So the two of the key benefits why you would want to have or consider having a holding company. First one is for tax planning, and the second one is for wealth protection. So let's jump right into an example of wealth protection. And I called it creditor protection. Perhaps a different word could have been asset protection. It's one and the same. You do want to protect the assets of the company from any creditors, banks, lawsuits, that sort of thing. So what happens in this situation is the operating, if you have retained earnings in your operating business, so retained earnings is income that's left over after your taxes have been paid, salaries have been paid. So there's money that's sitting there. You can transfer it. Through a dividend, tax-free to the holding company. So the holding company can either retain that money and grow it or reinvest it, or which is the benefit. For the operating company, what it means is oftentimes it reduces the income that the operating company has, therefore reducing the taxes. So that could be a benefit for you. So let me just give you a quick example. I'm just going to take this off the screen for a second. So let me just kind of give you an example of a situation I came up with. And I love using very simplistic examples. I'm going to do this very high level so you can understand it and hopefully have a little bit of fun with it. So my company is called Krista's Home Renovation Company. And let's say my company has been very successful. I've been in business for 10 plus years. Over the last 5 years, I've had consistent income coming in. So I've had retained earnings in the business for each year, approximately $100,000. So over a 5-year time frame, I've accumulated $500,000 in cash. So I'm pretty proud of myself. So Krista's Home Renovation Company is a company that renovates high-end homes. So we're talking $1 million+ homes. So obviously that's not the case, but anyhow, for the use of this example, so I have $500,000. I'm feeling pretty proud of my business. Unfortunately, one of the houses that we were renovating, the company was renovating, installed a high-end furnace, so it's energy efficient and the best in the market can buy. So unfortunately, there would have been a little problem with the furnace. So let's just say, for example, that something short-circuited in the furnace and it caught on fire and it burnt down this house that we were renovating. So lo and behold, Krista's Home Renovation Company is now being sued. So that $500,000 that accumulated in retained earnings is now at risk of losing it. So if, for example, if I had a holding company in place, I would have transferred through company dividends to my holding company. So the holding company would have held on to the assets or the cash of $500,000. So that adds an extra layer of protection. Doesn't mean that those funds may not be at risk, but it does make it a little more difficult for a lawsuit to be able to get their hands on that money. So let me just move on to another benefit of a holding company. So I'm just bringing up the title, capital gains exemption. So this is a really important one. And there's a lot of complexities around this. So you definitely want to have a great tax accountant to be able to navigate through the ins and outs of the capital gains exemption. However, in Canada, if you have a CCPC company, which most small businesses in Canada do qualify for as a Canadian controlled private company. So if you are a private company, you may be eligible to have a tax-free capital gains of just a little bit under $867,000. So in essence, what that means is you can sell the shares of your company at a gain of $867,000 and not pay any income tax on it. So that is a good thing to know. And that's why it's important when we're talking about succession planning, or if you are thinking about selling your business, you do need to speak with your advisors on that, because we do want to have something in place to minimize the taxes that you're going to pay. So let me just bring up an example again so I can show you what I'm talking about. So let's go back to my example of Krista's home company, home renovation company. So in this case, we know I have $500,000 in retained earnings sitting in the operating company. So in order for me, if I'm going to be selling the company, and say, for example, somebody has made an offer of $800,000 to purchase my company. So I'm really excited about that. The problem is, in order to get the capital gains exemption, there's 2 or 3 criteria that you have to meet. First one being it's called an asset test. And what the asset test means that if you have more than 10% of your assets in a non-active business, you do not qualify for the capital gains exemption. So in other words, the non-active business is also sometimes referred to as passive income. And passive income means things like cash, interest from investments. You could have royalties, or you can even have rents that are rental income coming in. So it's not part of your day-to-day business. So in the case of Krista's home renovation company, we know that $500,000 is sitting in cash. So if I do the asset test, I'm going to fail. So what that means is the sale of my company, $800,000 is taxable. So capital gains are taxed a little bit differently. So just for, again, simplicity, on the sale of $800,000, because I failed the capital gains exemption test, it would result in me having to pay, or the company having to pay, about $160,000 to $170,000 in taxes. So that's not good. Versus, if we use the same example and I had a holding company set up, I'd be able to transfer the retained earnings to the holdco. And if I did the same asset test, again, the cash is not sitting in my operating company, so I would pass the test, and therefore I'd have 0 taxes to pay. So it's a huge benefit of having a holding company. And if you see, oftentimes the holding companies are best for mature businesses, but that's not always the case. And again, it depends on each individual example, and as well what type of risks that your business has. So let's just move into another example of a benefit of the holding company. And there's always a benefit for tax savings. Now, mind you, with the changes that the Canadian government has brought in place recently on passive income, it's a little bit more complicated. So again, you would want to speak with your accountant to see how it applies for your particular situation. So I'm not going to get into that example today just because of time. But I do want to touch on tax deferrals. So again, another benefit of a holding company is tax deferral. So what I mean by that is you're able to control when your income is earned and therefore control when you have to pay your income tax. So let's use the example again of Chris's home renovation company. So I know I have about $100,000 in retained earnings. Let's say, for example, that I'm going to pay that out to myself in dividends for income to live on. But let's say that, gee, I've received a contract to be for 1 year to be a TV host. So that contract is worth $100,000. If I was to obviously get paid the $100,000 for being the TV host and also pull the income from the company, which is $100,000, it's going to put me in a very high income tax bracket, which is not necessarily a good place that you want to be. So if I had the holding company set up, I could transfer those retained earnings to the holdco, have it sit there. So this year I've received the income from my TV show, and then after my 1 year contract, I could pull the dividends in. So therefore it defers my income to another period in time, which I'm going to pay less taxes on. So that's what we mean by tax deferrals. And the last thing I'm going to talk about today is estate planning. And again, this is going to be very simplistic, very high level example. All of the things I've talked about today, I will be going into greater detail down the road. But again, I just want to provide a quick overview of what the pros and cons are of a holding company. So estate planning is a great idea where we can come into having some great financial planning. So, for example, I'll use the example that my dad has a very successful microbrewery. And let's say, for example, the microbrewery is worth $5 million. And he wants to bring me as his daughter into the business, but he wants to retain control of that business because he knows that I don't know a lot about microbreweries. So he still wants to maintain control over it. So we'll use the holding company to create what we call an estate freeze. So basically what it does, it locks in the current value of his shares. So what that does is he still retains control of the company. Any future growth from the shares is going to be taxed for me, and I guess it'll be my burden to deal with, not his. So it's a win-win for both of us. Likewise, at the time that, for example, if my father did pass away, or when he does pass away, it also locks in the value of those shares as well. So there's less taxes that would have to be paid at that time upon his death. So again, holding companies are a great financial planning strategy for a lot of entrepreneurs and a lot of businesses out there. Oftentimes they've been misunderstood, and I can't tell you the number of times I have clients that would have a holding company set up and they just basically use it as a flow through for dividends. Perhaps it's not the most efficient way to do that, and they're not necessarily taking advantage of all of the financial planning tools that we have associated with holding companies. So let me just go on to see here if there's any questions. And I guess there isn't. So if you do have any questions regarding anything that I spoke with you about today, please don't hesitate to reach out and give me a call. I'll be more than happy to chat with you. And I look forward to seeing you here again next week. Thank you so much and have a great day. Bye-bye.